Anything that comes in a business is a debit, and anything that goes from the business is a credit. So if there is a number one is a transit, there are the transactions. Number one transaction is a sold a stock on cash 40,000. Here, whenever anybody sell the stock, the cash will come into the business. So cash will be the debit with the 40,000, and a stock will go gone from the business. So the stock will be the credit with the 40,000. Cash is a debit with the 40,000, and a stock is a credit with the 40,000. Number one. Number second is purchase building on cash 30,000. Here, whenever anybody purchase a building, so the whenever anybody purchase a building, so the building will come into the business because we are purchasing. So we are purchasing the building will come into the business a debit. Building will be debit with the 30,000, and cash will go on from the business, so the cash will credit with the 30,000. So there are the six continuous steps of accounting. In the accounting, there are the six continuous steps. Number one is the data, and the data we have studied that the purchase building on cash, sold stock on cash, receive interest income, rent received, paid for salaries, paid for the transportation expenses, traveling expenses, transportation. In the written simple statement, in the written statement, the transaction is known as a data. Transactions are known as a data. Number one. Number second is number one was the transactions we have studied. Number second is number second is the purchase. Number second is the debit and a credit. Practice for the debit and a credit. Here we have made the practice for the debit and a credit. Anything that comes in a business is a debit. Anything that goes from the business is a credit. Purchase building on cash. So the building will come into the business as a debit, and cash gone from the business is a building is a debit with the so the purchase building on cash, that means the building will come into the business. So the building is a debit with the 30,000, and the cash will gone from the business. Cash will because we are purchasing the building on a cash. So the cash will gone from the business. Cash is a credit with the 30,000. So the number third is a general ledger, or we can say the net balance. So the net balance, we can find out the net balance by subtracting debits from the credits. So that is subtracting debits from the credits. Here we have two entries. There the number whenever there are multiple entries, so we have to post all the debits and the credit debits to the debit side, and the credits to the credit side of the ledger. Example, we have a cash ledger, so we have to post all the debit entries of a cash, and all the debit entries of a cash into the debit side, and all the credit side entries of a cash into the credit side. Only the cash entries into the cash ledger, and a stock ledger, all the entries of the stock on the debit side, and all the credit side entries of a stock into the credit side. So we have to post, and we have to make the difference between subtract the by subtracting debits from the credits. So this is a general ledger. So we have to, the difference between both debits and credits is known as the balance, net balance. So net balance, after the net balance, we have the number whenever we will receive the net balances of cash and stock and a building. So these net balances will be shift towards the trial balance. Number fourth is the trial balance. The shift of net balances from the net balance to the from the ledger, and the shift the net balances from the ledger towards the trial balance is known as the trial balance. The cash balance, the stock balance, the building balance, and after that, number fifth and the sixth step is known as an income statement and a balance sheet. This is from the trial balance. We have to shift in these two main reports in the in the income statement, in the one on the one side there is a cost amount of the cost, and on the second side there is the amount of the incomes. So the amount of cost is subtracted from the amount of incomes, so the net balance will be known as a profit or the loss. Here in the trial balance, there is the multiple accounts. There are the all of the accounts are completed into the trial balance. There is expenses. There are the incomes. There are the sales. There are the liabilities. There are the capital are there into the trial balance. In the income statement or balance sheet, we have to here we have one thing that the cost, there is the cost and income. The difference between cost and incomes, the incomes just like sale is income, not the cost, and the cost is tax is a cost, tax is a cost, rent is a cost, salaries expenses is a cost. So these are the cost, and there is some expenditures known as a cost, and there are the incomes known as incomes, revenues. The insurance income, interest income, and any of the income is known as a income. So there is a cost and incomes and assets including the building is an asset, and the cash is an asset, bank deposits is an asset, investment is an asset, car is an asset. So these all the accounts which came into the trial balance, which comes into the trial balance, are shifted to as these five categories. We have to practice all the accounts class. We have to classify all of the accounts into five categories, and whenever we have classified all the accounts, so we will post these accounts from the trial balance to the income statement and the balance sheet from the trial balance. So the from the trial balance we have to shift income is in the cost and incomes into the income statement. On the one side there is a cost on the income statement. In the income statement there is a cost amount, on the amount of, on the one side there is the amount of a cost, and on the side and on that side there is the amount of the incomes. So the difference between incomes and a cost is known as a profit or the loss, and this is the this profit, and there is a profit and the loss. So and another report there, that is a balance sheet. Number last is the balance sheet. So the last is the balance sheet. After the income statement there is a balance sheet. From the we have to shift posts and shifted, we have to shift the amounts from the amounts of assets and the liability. On the one side there is amounts of assets, on the other side there is a amount of liabilities, capital, and the profit from the trial balance on the other side. So this is a balance sheet, income statement and a balance sheet. And the number last is the last of the all the accounts, all the accounts including, there is a cash flow statement, there is a bank reconciliation, there is a adjustments, and this is a description, debit, credits, and the balance. Description debits into the description debits column, credits column, and the balance column. This is for all these reports. Along with there is a there all along with all along with these reports, these reports, there is a three kinds of documents. Document known as the vouchers. Number one is the operational document. Number second is the investment document. Number third is the financing documents. So these are the three documents which is very important for the voucher or for the proof purposes.